Hello and welcome to our latest LinkedIn Live event and the first in our series of currency options webinars. We're just going to give 10-15 seconds for the attendees list to fill up and then we'll get going. Okay, so today's topic covers a family of financial instruments growing in popularity amongst corporate hedgers, but often misunderstood. Truthfully, these products can create a valuable revenue stream for banks and brokers, but they are almost infinitely useful despite being quite complex. So today's session, as per the title, is aimed at business leaders and financial decision makers from non-financial businesses. So if you work in FX or financial markets, please leave. Otherwise, I'm your host, Harry Mills, director at Ockley Markets, a London-based currency management firm servicing SMEs, multinationals, and private clients. As for the agenda, we'll be walking through the basics of puts and calls, buyers and sellers of options, the contracts themselves, premiums and moneyness of the contracts. My favorite phrase, combining options like Lego, and zero cost options products. And you can find me on LinkedIn, linkedin.com/in/Harry Mills. And you can, on the LinkedIn page for this event, leave me a comment. If you have any questions throughout, I will answer if relevant. Otherwise, I'll come back to you with a message later. I should add at this stage, option contracts are complex financial instruments. And this topic is rather onion-like in that there's many layers of understanding to unearth. But today, we'll be taking you through an introduction for the only need-to-know info, a pretty simple way, precisely the same way that I coach people from the market, and indeed how I wish I was probably taught many years ago. And a few important disclaimers. So this is all educational and illustrative stuff. We're not going to distribute or reference any prices. We're certainly not going to give any personal recommendations or advice. We're not going to discuss the suitability or appropriateness of options for your business. And all the content will be equivalently freely available online or in textbooks. So let's get cracking. So let's look at some basic contract information just to familiarize ourselves with how the contracts work. The first thing to note is that the vanilla option is the most basic type of contract. And there are many types of options, but today we're only going to be focusing on vanillas. And the most important basic point of vanilla contract is that the buyer of the option, the buyer of the contract, purchases the right but not the obligation to do something. So in FX, that means to sell one currency to buy another. So for example, to sell pounds to buy dollars. And you do that for an agreed amount, or an agreed notional amount, e.g. £100,000 at, or potentially before, but usually at an agreed future date, like 3 months' time, and at an agreed strike rate. So let's say 125, and exchange for a premium, let's call it £4,000 or 4%. And we'll stick with those contract terms throughout this presentation as an example. So we'll call back on those from time to time. And I'll also just mention here that remember, for every buyer of an option, there is also a seller. So if I've bought that option or an option, someone, usually a bank or a broker, has had to sell it to me, so to take the other side of the trade. So there's a few basics, some contract terms. Now let's look at puts and calls. So these are the two types of vanilla options. So like with any underlying asset, whether it's a stock or a currency or a commodity, you might want to bet on or insure against a directional movement in the price. You can gain this exposure or protection through options. So a put option is the right to sell the underlying asset, whether it's a stock or a currency or whatever. And a call option, so the right to call, to buy, is the right to buy from the underlying. It might be useful if this is new to you to think about stocks. So take Vodafone, it's around about 66 pence at the moment. If you think that 66 is going to go up to 70 to 75 or to 80, not sure it will, then you might buy a call option to gain that exposure. Conversely, if you think it's going to go down to 60 to 55, then you might buy a put option to gain that exposure or to protect against a downward movement. Very easy in stocks because there's just sort of one price and a one directional bet. In FX, it can be a little confusing because there's two currencies involved, of course, in the currency pair. But to remind you of what you're looking at, in FX, the put and the call refers to the base currency. So in sterling dollar, in cable, GBP USD, we mean against the pound. So it's a put on the pound or a call on the pound to sell or to buy the pound against the dollar. So if you sell the pound, you're buying a put option on the pound, you're therefore buying dollars. Same for euro dollar and dollar yen, etc., etc. So it's a couple of examples at the bottom there. A UK importer, if you're buying bits from America or from China and you're buying dollars, then you might buy a put option selling sterling to buy dollars. And conversely, an exporter might buy a call option to buy sterling and to sell dollars. So some basics of puts and calls there. There's no questions on the chat so far, so we'll move on. And this should be about 20, 25 minutes, by the way. So let's move on to premiums. So these bets without obligation, because I remember I said you have the right but not the obligation. They aren't free. There's no free lunch here, and the cost of entry is called a premium. So the buyer of the option pays the premium, and the seller of the option receives the premium. It's a little bit like car insurance-ish. You know, you pay the premium for the cover or the protection or the exposure, and then the seller of that insurance or the contract, the option, takes in all of those premiums. Now, option premiums are influenced by several factors. We don't really need to worry too much about this stuff right now, not for the scope of this session, bar understanding of some of the basics, which are actually pretty intuitive. So how close is the strike rate of the option to the market rate? So what do I mean by that? Well, if it's a put option, the right to sell, then the higher the rate, the higher the premium. Conversely, if it's a call option, the right to buy, the lower the rate, the higher the premium. Why? Well, you buy low, sell high, right? So you'd rather buy sterling at 115 than you would 130. So 115 is going to attract a higher premium, a higher cost of entry. That's a nice little way of thinking about it. And then how far in the future is the option's expiry date? So option contracts have expiry dates. This is the time to expiry. The farther the date in the future, the more chance there is that the option is going to be exercised over time, therefore the higher the premium. And finally, volatility. So how volatile do we think that the market will be in the future? And this is a measure called implied volatility. It's the market's expectation of future volatility. And it's really the volatility that's implied, Q in the name, by the premium of the option. These two terms can be reverse engineered by the calculation to solve one for another. So that's a little bit about premiums. And we'll now move on to looking at some payoff charts. So quite a bit of detail here. There's lots of squiggles on the chart. So let's look at those four charts, and we can see that they're labeled as either puts or calls and puts, vertically, and long and short. That means to buy or to sell horizontally. With on each chart, the x-axis is the market rate going left to right, and the y-axis is the profit and loss. So in pounds or dollars or whatever currency we're using, that's the P&L for the transaction. So let's take the top left, a long call option, a bought call option. Remember, that's the right to buy the underlying. So the right to, say, buy pounds and to sell dollars. We can see that the premium is a cost. It's a debit from the outset. We know that because the profit and loss level below the strike, and the strike being the kink in the curve, and so to the left of there, it's below the zero line on the P&L y-axis. So we can see that there's a debit from the outset. Conversely, for the short options, we can see that the premium is a credit from the outset. And we know on the first slide, we said that when you buy an option, you pay, and when you sell an option, you receive. So looking at the curves themselves, the kink in the curve is the strike rate, and the break even is simply the point at which the return on the option matches the cost of the premium. So in the case of the long call option, it's very simply, so the strike plus the premium gives you the break even. The curves also tell us the maximum loss and the maximum profit, as I've got in the little bullet points on the left-hand side there. So we can see, for example, that if I buy an option, so if we look at the two long options, my maximum loss is only the premium that I've paid, that I've foregone. But for options that I sell, then the P&L can be quite different. It's not. It's for a call option that the sky's the limit. For a put option, it's restricted to 0, of course. So these are quite useful charts to think about how an option pays off. Where the premium comes in, if we pay or receive the premium, and what the potential profit and loss payoff is. But it might not be that useful for a corporate hedger, for an FD or a CFO or whomever, with real underlying deliverable foreign exchange needs. So most people tend to prefer to read the y-axis instead of a P&L. They prefer to read as a realized exchange rate. So if the market goes to X or Y and it goes up or down, what rate will I ultimately get from the contract? So we can convert the y-axis into an exchange rate. So the chart flips, kind of inverts in a sense, and then we can see what rate we get. And we also factor into the chart that the underlying transaction will take place no matter what. So if you need to sell pounds and buy dollars, then we factor that in with some spot rate participation. So the image below, we can see the original put option image with a P&L payoff converted into an exchange rate. So below the strike, let's imagine I've bought a put option at 125 to sell pounds and to buy US dollars. If the market rate ends up lower, then the contract will be in the money, hence I'm protected. If the market rate ends up higher, then the option is out of the money. I would walk away from the contract, and therefore the contract is worthless, and I would hence trade at the spot rate. So I see this 45-degree upward participation as I get a better rate for the market moving higher. So this is how we can start to look at the payoffs of options, so it makes a little bit more sense to someone in business who wants to understand what rate they're going to get rather than a profit and loss on a contract. So moving from charts into moneyness. So this is exactly the drawing that I prepare for one-on-one coaching sessions with people in the market, people I've trained over the years. So at an option's expiry date, the contract is either worth something or not worth anything. Don't worry about the rate being exactly the same as the market rate at the money for now. We can forget that for a moment. So it's either in the money, it's worth something, or it's out of the money, it's worthless. We walk away, we forego the premium. You trade at the spot rate if you want to. So let's take our option struck at 125 again. That's the middle. I don't know if you can see my mouse, but that's the middle horizontal line here. 125 is the strike rate. If the market rate ends higher than 125, let's call it 130, then a put option is worthless. It's out of the money, but a call option is in the money. Why? Well, of course, a put option down at 125 is not really much use to me when the market's 130. Conversely, a call option at 125 is 500 points in the money when the market's at 130. And it's a mirror image to the downside. So again, an option struck at 125. If the market ends up at 120, puts are in the money, call options are out of the money. Remember, put is to sell, call is to buy. So I'd rather sell at 125 than I would 120. It's 500 points in the money. So I'd say draw that diagram and get yourself used to it. If you're stuck, then just think, if I can buy or sell in the market, say at 130 or 120, would I take the option that I've bought, or actually would I be better off using the market rate? And that will tell you instinctively whether the contract is in or out the money. And this is for bought options, remember. So if an option is exercised or not, what does this mean? Now, we've already gone through whether an option is in or out of the money, whether it's going to be exercised or not. But now we need to think about who bought or sold the option and what that means to them and to their cash flows. So the buyer has the right, the seller has a potential obligation. So remember that. So if I bought the option, I've got the right to exercise it if it's worth something. If I exercise that option, I'm exercising against the seller, who will therefore have to fulfill that contract. So let's take our example again at 125. let's use a call option this time. So I'm buying sterling, selling US dollars. If I bought that call option and the market rate ends up at 130, then I'm going to exercise my option to buy sterling at 125 and to sell dollars, because I can instantly, why? Because I can instantly sell those pounds back and buy dollars at 130, and I've made 500 points worth of profit. The bank or broker on the other side of the trade that sold the option to me would need to fulfill it, allowing me to buy sterling from them at a rate 500 points better than the market. And that's the point. If we sell options like the bank has sold to me, they might be obligated against. And that is how we start to build in obligation into a product, into a structure, a bit like a forward contract. So we'll just hold on to that thought for a moment as we move on to combining vanilla options. So we can buy and sell options independently. Or we can do this at the same time as part of a package or a multi-leg product or a structured option, sometimes they're called. I'll come back to why we might do this on the next slide, but for now, let's just think of the most basic buy and sell an option structure that there is, because we can recreate a forward contract using options. So what is a forward contract? It's a guaranteed exchange rate. It's a contract where you commit to selling one currency and buying another at a future date at an agreed rate. But we can also, as I said, we can also recreate that using options. A forward contract is also a trade that is either in the money or out of the money, depending on where the spot rate is compared to the forward rate upon the maturity of the contract. So let's imagine we are selling pounds, buying US dollars. So GBP USD, and that's the direction of the cash flow, sell sterling, buy dollars. We would create this forward using options by buying a put option. So I'm buying the protective leg. So that's the protective leg of the trade, the put. And I need to put some obligation in there. So let's say it's 125. I've bought a put at 125. That means if the market goes down to 120 or 115 or 110, I'm protected. But I need to have the obligation. So we need to do something else at 125 to make it like the forward. To do that, I'm going to sell a call option, which means if the market is above 125, then the buyer of that option, probably a bank or a broker, is going to exercise that option against me, and they're going to make me sell pounds to buy dollars from them at 125, which might feel a bit painful if the market is at 130 or 140, for example, but it's exactly the same as a forward contract in that sense. And for anyone who's thinking about the premiums, because we pay premium to buy an option and we sell we generate premium, we receive it to sell, the premiums meet at zero at the forward rate. There's a parity there if we use exactly the same rates, amounts, and dates. So hopefully you're with that. So with me so far, we've looked at puts and calls, we've looked at buying and selling, we've looked at premiums, and we've looked at when a contract is in or out of the money. Next, after looking at how to synthesize a forward contract, we're going to look at a few other quite basic products. So we can build options like Lego, right? Using like Lego bricks. That's one of my favorite phrases for this sort of stuff. And I'm going to show you how to do that. So let's stick with the same example, a UK importer. And I've bought that protective leg of that put option. So I need to sell pounds to buy dollars. And we've done that at 125. So hopefully that's you're still with me at 125, 100,000 pounds at 125 is the put option I've bought. I can sell a call option, 100,000 pounds at 125, and I get the forward contract as we've just described. But what if I make the 100,000 pounds 50,000 pounds for the call option I'm selling? Well, this makes a participating forward. What does that mean? Well, if the market is below 125, then I've still got my protection that I bought via the put option at 125. But if the market's above 125, no longer like a forward contract am I obligated on 100,000 pounds at 125. I'm only obligated on 50,000 pounds at 125. So that means that I'm 100%, 100,000 protected to the downside, and only 50%, 50,000 obligated to the upside. Now that 50 could be 40, 60, 70, 30, whatever you want it to be. But the point is we can start to bring in these contracts where we have a lower obligation compared to the protection. That's a participating forward. So what if we keep the strike rate the same on the sold call, 125, and that 100,000 notional on the call option, instead of reducing it to 50, we make it, say, 150 or 200. Well, this is quite interesting because now the obligated leg, the call option I'm selling, is now a greater notional than the protective leg. And this is called a ratio forward because my potential obligation, my potential liability is 2 times or 1.5 times my protection. So this is a leveraged option. It's a bit more sophisticated. There's a bit more risk involved. But let's change that 200 back down to 100 again. And we've got the synthetic forward again. But this time we're going to ratchet up the strike rate on the call option from 125 up to 130. So I've got my put option at 125 for 100,000, and I've got a call option at 130 for 100,000. What does this mean? Again, to the downside, I'm protected 100K at 125. Between 125 and 130, neither the put I've bought nor the call I've sold are in the money. So I can trade freely at the spot rate should I wish. But at or above 130, the call option I've sold will be in the money, and the bank or broker or whomever will exercise that against me. So that's a collar option. It gives you this nice payoff where you've got downside protection, a bit of upside, and then a cap on the upside at 130. And then if we make that 100,000 into 200,000, we get a ratio collar. So a leveraged collar is another phrase for it. And if you're thinking about premiums, yes, obviously we've doubled or 1.5 times the notional amount on the option that we've sold on the ratio forward and on the ratio collar, the leverage forward and leverage collar. So that's going to generate more premium, which can be utilized to give you a slightly better strike rate on the put option that you've bought. So that's how these leveraged options can give you enhanced rates or close to matching or better than the forward exchange rates at the time. So hopefully you're still with me so far. That's how to synthesize, that's how to structure a few quite basic contracts just by changing the rate and the notional amounts. And this premiums and zero cost option page is the last slide by the summary. So we're very nearly there, 25-ish minutes, as I said. Now, these multi-leg options do have uses. We can create and combine options to make some quite interesting payoffs. And it's quite a fun process to do, I must say. And if a client has got quite specific needs, then you can deliver something really quite unique, bespoke, and of interest. But something to remember is that when you buy an option, you pay, it costs money. When you sell an option, it makes money. So when it comes to product that has got no cost of entry to you, that is, you don't need to pay a premium to enter the contract, then it means that there's very likely a premium that is paid to enter the contract that the bank or broker is keeping as part of their profit on the deal. There's no harm in that, no problem in that. Well, that's how we can generate income on these sorts of trades. So how much income? It was very hard for you to tell, but it's quite easy for us because we've got the technology to calculate it. So that's something that we can do should you wish. Okay, and finally, a quick summary for you. So throughout the course of this quick 20-25 minutes, we've looked at puts and calls, so selling and buying the underlying, buying and selling the options themselves. So you can buy a put option and you can buy a call. You can sell a put and you can sell a call, which means you can buy the right to buy or buy the right to sell or sell the right for someone else to buy or sell the right for someone else to sell. It's quite a lot. We've looked at when an option is at its expiry date worth something in the money or worth nothing out of the money, you can walk away from it. And then also to whom. So if an option is in the money and you've bought it, it means the seller has to fulfill that contract. So it's out of the money to the seller. And what does that mean for their cash flows? And we've looked at how you can buy and sell options in the same structure. I've given you some examples of some basic contracts, some popular contracts. But please remember, if you're looking at an options calculator, to consider the direction of the cash flows to ensure that you're doing it right. So if you're keeping with our example, a UK import and you need to sell sterling to buy dollars, then you'll need to buy a put and you need to sell a call, for example, to maintain the direction of the cash flows. There are reasons why you might buy and sell calls and puts within a structure, but that's for for a future session, I think. And finally, remember that zero cost options aren't really zero premium. There's always a cost or a profit involved. If you speak to us, we can tell you what that is, what that looks like. That's it. Quick 25 minutes introductory session on currency options. It's time to close. So thanks very much for attending. Hopefully you found it useful. If you've got any follow-up questions or you'd like to talk to me about your business currency management, please reach out via LinkedIn message, by emailing me, harry@archimarkets.com, or just drop me a call, 0203 838 0250. We will be doing future currency options sessions, doing some more advanced stuff. But that's it for now. So thanks so much.